How's it going, guys? This is Top Down with TCM. We have a very special guest today, but just to remind you, I'm your host, Azaan Barlas. I'm with Jason Cruz and Weston Weinberg, and we are Top Down with TCM. We have Nathan Seawater with us today. Now, Nathan's a healthcare analyst, just like me and Jason, so he completes the Holy Trinity. And I want Nathan, could you introduce yourself a little bit and just talk about yourself?
Sure. Hi, everybody. My name is Nathan Seawater. Thank you very much for having me. I'm in TCM. I'm also the president of California State University Fullerton Student Managed Investment Fund, or SMIF. As you know, we're graduating this year, so we just announced a new president, Jericho, and I'm going to be on the panel Friday to help interview some of the next generation of TCM students.
Nice. Exciting. That's exciting. Well, we're happy to have you on as a guest. And I wanted to start with, I know you had a little bit of a different experience than most college students. You decided to travel the world for a bit and as well as live in New York. And I was wondering if you could tell us a little bit about your experience doing that and how it sort of shaped who you are and your perspective on the world of finance.
Definitely. Thank you for the question. It's a great question. So yeah, as you mentioned, I have sort of a different background. So after high school, I decided to just work. I worked and traveled and basically worked to travel throughout my 20s. I didn't go back to college until much later, which I'll touch up on at the end of this story. I worked a lot of random jobs. I graduated high school in 2005. So that should give you a pretty deep understanding of how old I am, really. And so hopefully that didn't shock everybody immediately, especially your viewers.
Well, you look great. How
Thank
about that?
Thank you. Yeah, I am 34. I'll be 35 this December. So there we go. As I said, I worked a lot of random jobs. I kind of did it in reverse. Instead of going to college right after high school, I traveled and worked. Some of my traveling took me overseas, like to Germany, for instance. One of my more memorable experiences even at Oktoberfest in Munich. But New York City is probably my greatest adventure so far. I spent almost a year in New York City trying to break into finance when I was 28 years old. I, at that point, had been trading for 6 years. I was an active trader starting around 2012, 2013. That's when I first read The Intelligent Investor. And believe it or not, I even got one of those dummies books. I got Day Trading for Dummies.
Nice.
And so those were the books that I started on that really got me interested back in all the way back in 2013. New York City, eye-opening experience. Anybody who's even thinking about going to New York, I highly recommend it. Pre-COVID, it was a happening place. I don't really know how soon it's going to go back to normal, but I love the city. The people are great. I did a lot on my networking there, although I wasn't able to break into the field directly. I did meet a lot of finance professionals and networked with them. Luckily, I had LinkedIn at the time, so I was making a lot of connections on LinkedIn, and it was a great experience, even though I wasn't able to quite break in. Remember, I didn't have a college education when I went out there. I took everything I had saved from working at a sawmill while bartending, and basically used all that money to not only swing the New York experience, but also the Europe experience where I went to Oktoberfest as well. So it was quite an adventure.
Nice. I guess I have a question, like, kind of about your experience and how it, like, relates to finance today. So I guess, like, a lot of us students are doing school online and everything. And a lot of the students that are watching, like, in Smith haven't really, like, networked. But you actually networked in person in New York. And that's such a totally different experience because all we've been doing is networking online. So, like, how much better is networking in person? And, like, what are some tips you can give people to network after Corona is over, basically?
Yeah, good question. So in New York, basically it was networking at bars. Really, we would go to the bars in Midtown, and we would basically party. And you could always spot the finance guys, and that's where a lot of the networking really happened, believe it or not.
Now hold on. You said you could spot the finance guys. I want to know what the finance guys, like, what was the tell for finance guys?
Oh, well, they're always wearing what they wore to work minus the tie. It was a pretty uniformed look, and they could really party. So that was always they also had some regular hangouts, and so I would say networking in person, lot stronger connections, big time. Networking just virtually, it's still good. You know, you can probably network a lot faster and in greater numbers virtually, because there's really no limit to the amount of contacts you can meet virtually. But in person, you're gonna make fewer but much stronger connections. You know, because you get that one-on-one experience, kind of like old job interviews used to be pre-COVID. So if you can get out there and do some in-person networking events, you'll make much stronger connections with people.
Yeah, it's definitely quality versus quantity when you do it in person.
Definitely.
Yeah.
What? So you said you did the reverse order instead of going straight into college. You did your own thing. You did jobs and you traveled, which is, everyone's got their own path. But I was curious as to what brought you into the field of finance. You know, when you made that decision to go back into college, why finance? Like, why not, I don't know, like history or something like that? Like, what opened it up for finance?
Definitely. So throughout my 20s, I kind of took an interest in trading. So I did it just casually for fun, on and off, kind of part-time throughout my 20s, the bulk of my 20s, actually. It was easy to trade just through apps, like Robinhood or TD, very easy apps to use on your cell phone or just on your home computer. I was just really interested in it. And so it started off as actually just a hobby. And it wasn't until I started working longer hours and multiple jobs when I decided that I wanted to have a real career and something that could, that wasn't more of a dead end type position. Now, I'm not saying bartending is dead end and can't be made a career out of, because it definitely can be. But I wanted something a little bit more challenging for myself, something that I could really push my limits. And I kind of had a knack for finance and an interest in it. And, I'm competitive, and I like to think I'm a problem solver too. And it just sort of all lined up. And so when I went back to college and I was still trying to decide if it was really something I wanted to do as a career, it all just sort of fell into place the more business classes I took, and the more I looked into the career as a whole instead of just what I wanted to do. Because when I went back to college, I would say I was a little bit more short-sighted and maybe had a more narrow perspective of what the finance field was really all about, and especially in our particular field of investments and corporate finance as a whole. And so now I've kind of really had my eyes open, and I can not only see what I was missing when I was in New York City, but also I can say that, I'm confident that I'm in the right field, after so many years at this point, especially since I was just a hobby trader beforehand. And it's quite a leap going from being a hobby retail trader to professional. It's a leap.
Can you open up a little bit about the difference and how it sort of changed your philosophy on investments and how it changed your whole philosophy on finance and investments?
Definitely. Yeah, and that's a good, important question. I would say that the years prior of just retail trading, your only responsibility is to yourself as a retail trader. You don't have a client. You have no obligations. You have almost no responsibility because you're trading with your own money. You know, you can follow whatever rules you want whenever you want. You make them up as you go, or you take your time. You can be completely emotional, illogical, and lucky, and hopefully you make money, and hopefully you haven't invested or traded rather your rent money. So that's the benefit of trading for yourself. You get to keep all the gains, but those misses can be really painful if you don't have a regular day job. And so when I was between jobs and trading, the sting of a loss was much more painful and detrimental to me between jobs than when I was trading while having a day job. And so when I started working full time and then trading part time, I just knew that I would rather be doing investing or some sort of facet of finance full time while trading part time. So I knew that it was no longer just a hobby for me, and that I was ready to try and take the next step instead of just trading for myself, even though trading for yourself is much, much easier for sure, because you can kind of Wild West it. That's kind of the fun of trading for yourself is having no rules, and you can do whatever you want for the most part. And the problem is capital, unless you have access to capital and leverage, which I was lucky enough to have at certain times of my life through my 20s. It can be really hard to get that one trade, to really make it, like earlier this year with GameStop, because those trades don't come around often. And you're really just lucky if you can catch one of those massive upswings that ran on basically just rumor. I mean, it's an amazing thing, and I've seen it happen over and over, and I've managed to miss all of them. So, you eventually rely on luck, which isn't very reliable, right? So, it's better to really learn the trade than just try to get lucky. So that's the biggest difference.
Well said. I love it.
Nice.
Thanks.
And real quick, just for the viewers, I have to talk up Nathan a little bit because he's very humble. Okay, I just want to throw this out here. Okay, number one, he's the director of the Student Managed Investment Fund, so he runs the entire thing, managing over 50 students and more, communicating with faculty. He's one of the he is not only knows a lot about stocks, but he's actually a lead portfolio manager for the bond portfolio, and has been for the entire year, on top of writing equity research reports. So my question for you is, since you are a bit of a bond expert, especially in this program, do sectors similar to the ones in the S&P 500, do they matter for bonds as well, when building a portfolio? And what sort of factors do you look at when you're picking out a bond to add to the portfolio?
Yeah, good question. I guess maybe I went over it maybe too quickly earlier, maybe not at all, but yeah, I've been doing fixed income and TCM since the summer boot camps. So I've been a bond PM since the beginning. Well, some sectors within bonds compared to the S&P are negatively correlated. So that's something that we look at. So we're looking at how the S&P, how the overall markets are doing. Sometimes if you want to invest in bonds, you're looking for things that are negatively correlated to the S&P. Some of them are positively correlated. So that's something to keep in mind as well. We look at sectors similarly to how we do in equities, but instead of looking for companies that are that may have a lower intrinsic value, we're really looking for stronger companies. We're looking for companies that have more secure cash flows. And I mean, this is depending on the type of bond that we're looking for, of course. But we're mostly looking for companies that are in strong positions, ones that are very stable, or if they aren't stable, our analysis from the bottom up can kind of beat the revised credit outlook for that company. So credit outlooks for companies tend to lag. So if we're looking at a company from the bottom up, we're looking for financial strengths. We're looking for things that basically you may overlook in equities because you're looking for a company that's fundamentally undervalued. We don't really care if the company's undervalued or overvalued or fair valued. We're looking for companies that will be able to deliver on their debt obligations, because our ultimate risk with bonds is any type of default where they can no longer pay us on the bond. I mean, that's really the torpedo into the ship. So elements of that nature, and again, it has a lot to do with the economic outlook. So we take that into account. That's probably one of the biggest factors we're looking at with bonds is the economic outlook as a whole. That way we can really implement an effective strategy and get some good yield out of our positions. Yeah, I hope that answers the question though.
Yeah.
Cool.
Well, you and Azaan are both like heads of the TCM Bond Portfolio, co-heads. And I know recently we saw as members of the team as well that we beat the benchmark by about 5%, which is absolutely ridiculous, almost unheard of for fixed income. And Nathan, even Azaan, you could chime in as well after Nathan speaks. What did we do so well that caused us to outperform the benchmark and create alpha the way that we did?
That's a great question. And again, with the traveling thing, and there's some distinct differences between the paths that we've taken, because I didn't go to college right after high school. And so the fact that you guys are about to graduate and you're still young, you're going to have college already under your belt and you'll be able to travel. I mean, that's kind of the best case scenario, really. So that's a good plan, especially if you can work virtually or even study virtually. That was a little bit less of an option when I was your age, right? Anyway, back to the bond portfolio. So from what I understand, we picked up a lot of that performance from being so underweight on treasuries. So part of our reason for going so underweight on treasuries was because we wanted to position the bond portfolio to take advantage of the economic rebound. This had a lot to do with our perspective on the economy and how we were analyzing it last year and even last summer. It was as soon as last summer that we were really trying to figure out the overall direction that the economy was going to take. We were still trying. The second wave hadn't happened yet, or even some of the third waves. None of that had happened yet. It was during summer. We were even trying to incorporate second and third waves into our thinking and how the market overall was reacting at that point. And at that point in time, the S&P was just roaring ahead. I mean, it was like no fear from the S&P. And if the S&P is any type of madly forward-looking indicator of the economy, things were looking really optimistic. So even with all the worst fears, and we were still in the height of COVID last summer, we were still positioning the portfolio for an economic rebound. And remember, this is a bond portfolio, right? And so part of the strategy was to go underweight on treasuries so that we can try to take advantage of lower credit quality bonds that offered a higher yield. And so part of the advantage was getting into those bonds while investors were still afraid. And so we were drawn to these more attractive, yielding, higher risk bonds. And, that's where the bottom-up research really came into play. And not only that, we were going to try and take advantage of sectors that were going to benefit from, rising yields and a recovering economy. So not only did we do underweight on treasuries and manage to benefit from the treasury sell-off before it happened, especially in these last few months, but we were able to take advantage of the rebounding sectors that were gonna possibly perform better. So like financials, for instance, as we started to increase our weight in financials, the financial industry was starting to rebound, so that was a really good thing. I know that we've put some weight into industrials that we're waiting to get yield on, but another sector I think that did really well was kind of our higher risk energy did really well. And I think there was a oil company in particular that did really well for us since last summer that helped to contribute to some of the wild outperformance that we experienced. So of course it's really great to outperform the benchmark and leave the portfolio in the best position possible for the next team. And so those were some of the forward-looking things that really helped us to capitalize on what had yet to occur, that now we get to kind of reap the benefits of, the better performance.
Yeah, he basically said it all. Like, we also had like a shorter duration too.
Yeah, I was gonna say the shorter
lot,
duration helped. Yeah.
Yeah, but really, our
lower average credit quality helped. Mm-hmm.
Lower credits when the economy is going crazy is a pretty good idea.
Yeah.
I mean, it's actually like pretty impressive how the bond team was able to beat the benchmark while like this, taking on a little bit higher risk credit, but still keeping it within the guidelines of being well above investment grade. Like, I feel like that would take a very forward-thinking attribution strategy to accomplish that. Can you talk a little bit about that?
Yeah, that's a good observation. Now we're still compiling the month-by-month attributions so that we can fully digest precisely where we picked up the most yield from. But right now, just from the preliminary observations of the attribution, the underweight in treasuries was a really big player, and then the overweight in some of these lower grade credits was also really great. Attribution, it's just like Professor Kim says, it's like an art, less a science. Obviously, we couldn't have pulled off that type of performance without having Professor Lucas, Professor Code, Professor Kim helping to educate us along the way. I mean, I hadn't taken a fixed income class until this semester, so I had started on bonds without even taking a formal bond class. Now I had learned about bonds, at least at the surface deep level, in several finance classes before that. But Professor Kim's Finance 435 class for the fixed income securities really helped. I mean, there's so many moving parts. It's like Professor Lucas says, there's so many moving parts with bonds that, if you were to just look at attribution, especially if you're looking at it over the quarter or even over the whole time we've been managing the portfolio, it won't give you the clearest picture. I'd say the best way, if you really want to look at the attribution for a portfolio, you'd want to look at it on almost like a flip book. You want to look at it from a month to month perspective. That'll get you not only the most accurate picture and snapshot of the attribution, but you'll be able to see it over time, how those fluctuations were able to provide us with pickups, here and there that ultimately resulted in our outperformance of the benchmark. I hope that answers the question.
Yeah, it definitely does. I'll ask one more question to close it out, if you guys don't have any more questions. So the big question that all the recruiters want to know is, what's next for Nathan Seawater? So what type of jobs are you trying to look for after you graduate? Or, what's next for Nathan?
Yeah, great question. Hopefully I can get you a great answer, especially sometime after this interview. I would love to come back while I'm in the field and speak to the future TCM and Smith students about exactly how I did it. But until I've done it, the best I can do is speculate. What I have going is more pending second round interviews, one in particular at BFSG I'm really excited about. Would love to get the position there. Mostly in operations, just like Professor Lucas and Professor Kosei and Smith. You don't have to jump straight into analysis. You can go into operations first to really break into your career. And it's a lot of the same story we've heard from a lot of workshop guests as well. That first job is just so difficult to break into. But once you break through and you can get that first position, it makes it easier to get the second and the third, if that's the course that you take. Yeah. So a lot of the positions I've been applying for have been operations. I've done some junior analyst positions too. I would say that for anybody in TCM, future TCM students who are going to be pursuing this route, the direct job applications from the professors themselves within their professional network is probably your best course of action. Trying to do it, from scratch over LinkedIn or on eFinancial Careers or any of those other websites, Handshake, for instance, that's the hard way. That you're choosing the harder path. Really, the best path from my experience and from what I've observed from the other TCM students have been the internal job applications that they'll usually send out and share through email for the teams for direct hires from the TCM program itself. So that's what I would recommend. And those are the ones that I'm pursuing the hardest for sure. Other than that, it's kind of a numbers game, with LinkedIn, I cast a wide net over a wide category of jobs within many different sized firms, going from the largest to just the smallest. It's really all about, I don't want to say it's about playing the odds, but in a way it's playing the odds and a learning curve, There's a strategic element to applying and interviewing that can't be overlooked.
Cool. That was a great answer. You're right. It's definitely a numbers game. I'm going to get that tattooed on my forehead, actually, a numbers game.
I pointed to your arm when you said that.
I mean, it's all a numbers game, so, But yeah, thank you so much, Nathan, for joining us today. This is a very special episode of Top Down TCM. And please join us again next week. Thank you.
Thank you for having me.